Welcome to the Tech Today podcast. It is your host, John Mayetta. Did you know that the United States had record inflation in the COVID period? So that 2021, 2022 stimulus period, we had record inflation that was higher than what we had in the early 1980s when Paul Volcker was Fed chairman. I'm not talking about CPI. What I'm talking about is growth in the money supply. So inflation, pre the inflation that we had in the late 1970s, early 1980s, the Fed, pre that period, used to define inflation as growth in the money supply. And in the 1970s, the Fed, of course, grew the money supply, which led to what was then record inflation. And the Fed subsequently conveniently changed the definition of the money supply to mean increases in prices. So now, where CPI is synonymous with inflation, that wasn't always the case. Inflation used to be defined as growth in the money supply. And if I have that on hand somewhere, that old definition of inflation that the Fed used to publish in its writings, I will try to dig that out and post it and then link to it in the show notes. But the inflation that I'm speaking of today, the growth in the money supply, we published a note on it earlier today. And I will link to that note in the show notes in this YouTube video. And you'll see how the money supply outpaced, the growth in the money supply outpaced what we had in the early 1980s. The chart that I included in today's writing used M2 as a measure of money supply. And then what I did was I backed out real GDP. Because another way to think about inflation is growth in the money supply that's unrelated to productivity. So, for example, when a bank makes a loan to, let's say, a company that's building a factory, and the factory subsequently produces whatever product it may produce, and that product generates revenue, generates operating profit, that's real economic value that's been added to the economy. So that bank loan, in effect, grows the money supply. It's the commercial banks that grow the money supply. The Fed credits their account, but it's the banks who ultimately extend those loans that expand the money supply. So that's real economic growth. So money supply growth that's tied to productivity does not result in inflation. If there's a direct link between growth in the money supply and growth in productivity, that growth in the money supply is not related to inflation. However, when you have growth in the money supply that is not associated with an increase in productivity, so money supply growth is not related to productivity, that equals inflation. When you have money supply growth, but you don't have growth in productivity, that creates economic slack. And that money supply growth needs to find a home. And so typically what you'll have is, people will spend that money as what happened during the COVID stimulus period. They bid up the price of equities, right? Equity valuations got massively inflated. Various asset classes got inflated, whether we're talking about automobiles, houses, cryptocurrencies. I think the cryptocurrencies lost a little over $1 trillion in value from the peak to the trough. And that's what happens when you inflate the money supply. You have wild speculation. In addition to various asset classes being bid up, you have the price of everyday goods and services obviously got bid up. And some of those prices obviously have abated. But nonetheless, the Fed is always the bad guy when the question arises as to whom caused inflation. It's always the Fed. It's always a monetary phenomenon. And the Fed in the 70s got wise to it and started to spin. The Fed's very good at spin and very good at causing inflation. And so that spin back in the 70s was to redefine inflation. But if we hold the Fed to its old definition of inflation, which is the one I like, growth in the money supply, you can see plain as day that we've never had an inflationary period like we've had in the 2021, 2022 period as a result of our response to the COVID lockdowns. So the fiscal side obviously is also guilty because their stimulus programs are what caused the Fed to print money to subsidize those programs. But the Fed didn't have to subsidize those fiscal programs. The Fed could have held firm and said, you know, if you, Treasury, go and issue $2 trillion of new debt in order to generate proceeds to then mail checks to people, what was referred to as helicopter money at the time, we don't support that stimulus program, and we're not going to participate. So if you can issue new debt and get private entities or sovereign buyers to buy those new issues, fine, but the Fed's not going to participate. We're not going to print money to buy your new Treasury issues. So we're not going to support this program. But the Fed, of course, supported Treasury's initiatives. Remember Powell fist bumping with Treasury Secretary Mnuchin at the time and buddying it up to Yellen when the Biden administration came in. So Treasury and the Fed have been in lockstep since 2020, since 2008, 2009, frankly, with the bank bailouts. And that wasn't always the case, and that's not how those weren't the original designs for the Federal Reserve. The Federal Reserve was supposed to act independently, not be the lapdog for Treasury. So don't let anybody tell you differently. We had record inflation in 2021 and 2022. There's no doubt about it. Check it out in the show notes. That's all for now. See you next time.